on that sound. It's instantly recognizable, isn't it? The kind of the quintessential sound of refreshment. The brand that's just woven itself into the fabric of global culture for, well, over a century now. But as we sort of uncork this topic today, what is it about a company like Coca-Cola? I mean, over 135 years old. How does it stay not just relevant, but this absolute powerhouse in the global economy and, a darling of a very particular type of investor? So today, yeah, we're taking a deep dive into Coca-Cola, ticker symbol KOO. It's a company synonymous with refreshment, absolutely, but it's also, I think, a truly fascinating case study. You look at the business resilience, the financial strategy, and this constant, almost invisible adaptation. We've got a really interesting stack of sources for this one, everything from, detailed investor reports, their latest earnings call transcript, all the way to a fresh, pretty sharp analysis from the Motley Fool. We're going to try and get beyond just the fizz, right? Understand the foundational currents that keep this Titan moving.
Absolutely. Our mission today is really to unpack what makes Coca-Cola tick, beneath that iconic red and white surface. We'll explore its, frankly, unparalleled dividend legacy. We need to understand its unique and actually surprisingly agile business model. We'll dig into its recent financial performance too, see how it navigates this volatile world, and importantly, examine how it's actively adapting. Evolving consumer tastes, global challenges. It's a lot. So whether you're prepping for a big meeting, maybe just catching up on the beverage industry, or honestly, if you're just incredibly curious about what sustains such a dominant brand, we'll try and identify the key nuggets of insight for you. We really want you to walk away feeling well-informed about how a behemoth like this not only stays on top, but, how it plans for the next century.
We promise we're definitely going beyond just the fizz here. We're going to reveal how this company maintains its market dominance, what it truly means to be a dividend king in a world of constant change, and how it's innovating to stay profoundly relevant. I mean, get this, they're experimenting with a Sprite plus tea blend.
Yeah, I saw that.
And even a new Coca-Cola offering in the U.S., made with cane sugar this fall. Story of consistency, yes, but also, I think, surprising strategic moves and this relentless drive to adapt that keeps them right at the forefront. Okay, so let's unpack this first part with a sense of wonder, maybe. We're talking about a company with a truly staggering history. Coca-Cola, founded way back in 1886, Atlanta, Georgia. Dr. John Stith Pemberton. Just, think about that for a moment. What started as a single beverage sold in a pharmacy, kind of a curiosity, has ballooned into this sprawling global empire. The company's been around for over 135 years, navigating through 2 world wars, economic depressions, tech revolutions, huge shifts in consumer culture. That's not just luck, is it? What's the secret sauce, for that kind of longevity?
You're absolutely right. It's far from luck. This isn't just a long history. It's a living testament to incredible longevity and I think a remarkable capacity for adaptation. The real insight here isn't just how long they've been around, but how they've managed to stay relevant across such vastly different eras. We're talking about a company that now operates in over 200 countries, offers more than 200 brands. This pervasive presence, it means Coca-Cola isn't just a beverage company. It's a global cultural touchstone. And to put its sheer scale into perspective, Coca-Cola sells an astounding 1.9 billion servings of its beverages per day.
Dang.
Yeah, per day. That's nearly a quarter of the global population choosing a Coca-Cola product every single day.
That's just a mind-boggling scale of daily interaction. And it's not just about how many bottles they sell. It's about the sheer undeniable power of the brand itself, right? Our sources highlight that its brand value alone exceeds US $83.8 billion. That's more than the combined value of global giants like KFC, Subway, Budweiser, altogether. It truly is a cultural phenomenon, recognized nearly everywhere. But for you, our listener, what does it truly take for a brand to achieve that kind of enduring global status? And critically, how does that huge brand equity actually translate into tangible business advantages for Coca-Cola? Beyond just being a household name. How do they keep that connection decade after decade?
Well, that enduring brand equity is a critical, almost invisible foundation. The true insight, I think, is that it grants them immense pricing power. That's a key competitive advantage in any market. People aren't just buying a drink, they're buying into the trust, the nostalgia, the consistent experience that the Coca-Cola brand delivers. This lets them maintain stable sales volumes and, more importantly, the ability to slightly increase prices year after year, even in inflationary times. This strong brand loyalty acts as a significant barrier to entry for competitors, too. makes it incredibly difficult for a new brand to challenge their dominance. This unwavering ability to generate consistent cash flow even when things get tough economically, that brings us directly to their legendary status as a dividend king. And what's truly fascinating here is that Coca-Cola has increased its dividend for 63 consecutive years.
63.
63. Think about that for a moment. This isn't just about paying dividends, it's about increasing them year after year for over 6 decades straight. That earns it the extremely rare title of Dividend King, right? Reserved only for companies with 50-plus years of consecutive dividend increases. The profound insight here, I believe, is that the streak isn't just a testament to financial health. It reveals a deep-seated, a corporate DNA, where a shareholder return is so profoundly embedded in their philosophy that it probably influences every major strategic decision they make.
That's a powerful statement. It's just a rock-solid financial foundation and a consistent, predictable cash flow generation that, frankly, few companies can match.
Right.
But for a company that also needs to innovate rapidly, invest in new markets, does that commitment to such a long streak, this almost sacred obligation to continuously increase dividends, does it ever constrain their ability to make bold moves, maybe initially unprofitable long-term investments, or to pivot quickly when needed? Is there a tension there?
That's a very sharp and important question. And yeah, it's a tension many companies face. However, with Coca-Cola, the balance seems to be maintained through several mechanisms. Firstly, their core business generates just immense, consistent free cash flow. We'll talk more about that later, which gives them significant capital to both fund dividends and invest in growth. Secondly, their strategic investments are often, carefully calculated and integrated rather than just pure moonshots. And thirdly, the market rewards this consistency with a premium valuation, right? Which indirectly lowers their cost of capital, making certain long-term investments more viable. So while the dividend commitment is paramount, absolutely, it's underpinned by a business model that's designed for both stability and strategic expansion. For you, whether you're an investor meticulously building a portfolio or maybe just an observer of corporate giants, this consistency speaks volumes. Underlying business strength, management's unwavering competence. It provides a unique kind of peace of mind, I think. Knowing that such a foundational company has prioritized and delivered stable, growing returns for so long, it reflects a deeply embedded philosophy of financial prudence and strategic long-term planning.
Right.
Which brings us to another truly fascinating aspect of Coca-Cola. Its business model. For a company of its, gargantuan scale, the how is just as intriguing as the what. Here's where it gets particularly interesting and maybe a little counterintuitive. They don't even own most of the bottling operations.
Exactly.
Instead, Coca-Cola primarily focuses on what? Supplying the concentrate for its drinks.
The secret formula.
Right. Building its powerful brands, driving marketing, pioneering product innovation.
Yeah.
And the independent bottlers, they handle the heavy lifting. Manufacturing, distribution, the complex logistics that get the product from the plant to your hand. It sounds incredibly efficient. But does it ever create a tension? Does Coca-Cola ever feel, a loss of control? Or maybe a dilution of quality standards by not owning all those crucial bottling operations? That's a very insightful question, thinking about those potential tension points. But the true genius, I think, of this asset-light franchise model for Coca-Cola isn't just about cutting capital expenditure, though that's huge. It's how it acts as this sort of invisible hand, allowing them to expand into a diverse, sometimes politically sensitive markets, or to scale really rapidly by empowering local partners.
Well, interesting.
This makes them a global brand that's paradoxically deeply local everywhere. So while there is maybe a perceived giving up of direct control, Coca-Cola maintains super stringent quality standards through robust franchise agreements, operational audits. And the bottlers, they're invested in their local markets. They directly benefit from the brand's success, so they're highly incentivized to maintain those standards.
Makes sense.
This model keeps Coca-Cola's own capital expenditures remarkably low and margins high for the core company, leaving more room for those consistent shareholder returns, like the dividends we just talked about. It allows for rapid global expansion and adaptation without the massive direct capital investment you'd need to own and operate physical assets in every single market.
So if you're listening, this asset-light model is a key reason for their incredible stability and profitability. It allows them to be agile, profitable across incredibly diverse global markets without the immense fixed costs of owning all those physical assets. They're leveraging a global network incredibly efficiently, making them responsive to local nuances. Now, beyond that unique structure, they also boast an incredibly diverse product portfolio, right? Extends far beyond just sparkling soft drinks. We know the classic Coke, but that's just the tip of the iceberg. How do they manage such a vast and varied portfolio? Seems complicated.
Precisely. And zooming out, their ability to diversify their product portfolio is absolutely crucial for long-term resilience. Coca-Cola owns over 200 brands. It's a staggering number. This includes everything from Dasani water, Minute Maid juices, Powerade sports drinks, Costa Coffee, Fairlife Dairy, Sprite, Fanta, Smart Water.
Yeah.
And critically, they've also made these strategic moves into the growing alcohol ready-to-drink, or RTD, market.
All right, the RTDs.
Yeah, with products like the Jack Daniels and Coca-Cola RTD, Topo Chico Hard Seltzer, and even a recent acquisition of Bilson's. That's a premium alcohol RTD brand in Australia. This broad diversification means they're not solely reliant on sugary sodas, which, directly addresses a major ongoing consumer trend towards healthier options in new beverage categories. It's a deliberate strategy, really. Spread risk and capture growth wherever it appears.
That's incredible. They're constantly adapting their offerings to meet incredibly diverse preferences.
Yeah.
Health-conscious trends, functional beverages like energy drinks or those with added vitamins, minerals, new categories like plant-based options, 80s, I think it's called, and those alcohol RGDs. They're ensuring they remain relevant to your evolving taste, no matter what you're looking for. It's smart business. Spreading risk, capturing new market segments as they emerge. It truly seems they are targeting every drink occasion you can imagine.
Exactly. This diversification mitigates risks associated with, say, declining demand for any single product category, like traditional sugary drinks. It's a strategic move to ensure long-term relevance. They are targeting every drink occasion. Your morning coffee with Costa, hydration with Smart Water, a post-workout Powerade, and now, even your evening cocktail, ensuring they're always an option for you. This strategy also ties into another core strength that underpins their stability. Their products are considered staples in most households.
So what does this all mean for us? Even when times are tough, economy takes a hit.
Yeah.
People still reach for a Coke or a Sprite or a Dasani. That's a powerful position to be in. Beverages are considered staple products. People keep buying them, good times and bad. This inherent stability in consumer demand is a consistent engine, fuels predictable revenue, and consequently, those dependable dividends we talked about earlier. It's often a small, affordable indulgence or just a necessary refreshment that stays in the budget.
This resilience is precisely why Coca-Cola is often considered a blue-chip stock. It offers a level of stability that can be, reassuring, even when other, more volatile sectors falter. While the specific product mix might shift maybe more water during health trends, more affordable options during downturns, the company consistently delivers billions in revenue. This fundamental, almost inelastic demand contributes significantly to its reputation as a safe and reliable investment. It provides a reliable bedrock in many investment portfolios.
And for you, this means Coca-Cola products remain a reliable part of many households' budgets, regardless of economic conditions. That consistent consumer behavior underpins the company's ability to deliver consistent returns and maintain its financial strength.
Yeah.
It's not just a luxury. For many, it's an everyday item, a small moment of pleasure. And that's a powerful driver of long-term stability in any economy.
Okay, so diving deeper into the financial health, let's look at the metrics that truly underpin this ability and dividend reliability. Coca-Cola currently offers a competitive dividend yield around 3%, which is quite attractive for a blue-chip stock of its caliber, especially when you factor in the stability. What's more, the company typically increases its dividend by, say, 4% to 6% annually. This is crucial because it means your passive income stream from Coca-Cola isn't just stable, it's actually growing, often outpacing inflation, diligently protecting your purchasing power over time. Now, this raises an important question that often comes up. You might look at Coca-Cola's payout ratio.
Right, the percentage of earnings paid out.
Exactly. It typically hovers in the 70% to 80% range. And you might think, wow, that seems high, maybe even risky. A high payout ratio can sometimes signal a company is stretching to pay its dividends. However, with Coca-Cola's remarkably stable, predictable cash flow and that asset-light business model we discussed, this payout ratio is actually quite sustainable. The insight here is that it signifies strong financial discipline and a clear commitment to returning a significant portion of its earnings to shareholders rather than needing to constantly reinvest heavily in physical assets. In 2023 alone, the company generated over $10 billion in free cash flow.
$10 billion.
Yeah. This robust cash position provides management with ample flexibility. Fund dividends, execute share buybacks, invest in strategic growth initiatives. Their net debt leverage stands at a healthy 2x EBITDA. And for our listeners, EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically a measure of how easily the company can pay its debts from core operating earnings.
And 2 times is good.
2 times is very good, considered very robust, and it's at the low end of their target range, which further underscores their financial strength.
So for you, our listener, especially if you're an income-focused investor, these metrics just scream reliability and growth potential. It's the kind of company that offers a real sense of peace of mind. It's not just about getting a payout, but knowing that payout is secure and growing, a consistent contribution to your financial well-being. And this profound stability is largely due to what's often called Coca-Cola's economic moat, right?
Indeed. Morningstar, for example, assigns Coca-Cola a wide moat rating. That signifies its strong competitive advantages that enable sustained excess investment returns above its cost of capital for at least the next 2 decades. This dividend, essentially, is built to last for several key interconnected reasons. Firstly, its sheer global presence provides a deeply diversified revenue stream, insulates it from downturns in any one region.
Makes sense.
Secondly, Coca-Cola boasts incredibly strong brand loyalty, consistently ranking among the top global brands. This translates directly into steady sales volumes and significant pricing power. Thirdly, its products are genuinely recession-proof. People keep buying beverages, no matter the economic climate. Fourth, a relentless focus on innovation. From successful zero-sugar options to new health-focused beverages and categories, that ensures long-term sustainability. And finally, consistent management execution, prioritizing shareholder returns, disciplined capital allocation. It keeps the dividend a top priority. These factors create this powerful, self-reinforcing cycle of stability and growth.
Think about that for a moment. Campaigns like Share a Coke, reimagined globally, 10 billion bottles and cans across 120
A
countries.
huge campaign.
Yeah. It reinforced that brand loyalty by tapping into nostalgia, personalized experiences, or the This Is My Taste campaign for Diet Coke in North America. Inspired by social media insights, drove significant volume growth by speaking directly to how consumers describe their connection to the brand, using terms like crispy taste, which I found interesting.
Yeah, crispy.
This isn't just a company selling drinks. It's a company with a strategically built defense against economic shifts, changing tastes, making its income stream remarkably secure for you. They really understand how to connect on a deep personal level.
And that security is, well, it's supercharged by the often underestimated power of dividend reinvestment. For long-term investors, one of the most effective strategies is to just reinvest those dividends. This creates a powerful compounding cycle. Your dividends buy more shares, which in turn generate even more dividends. Over time, this can compound into significant wealth, quietly building your financial future.
Okay, let's unpack this with a relatable image. It's like watching a snowball roll downhill, right? Getting bigger and bigger with every turn, but with your money.
Exactly.
An example cited in our sources suggests that if you had made an initial investment in Coca-Cola, say 30 years ago, and consistently reinvested the dividends, your annual dividend income today would likely be many times your initial investment. It's a powerful long-term wealth-building strategy. And Coca-Cola's consistent dividend increases make it an ideal candidate for this kind of patient, compounding approach, letting your money work harder for you.
Now, regarding its stock performance, Coca-Cola, ticker KO, well-known component of the Dow Jones Industrial Average, classic blue-chip stock, in 2023 reported over $45 billion in revenue, reflects its strong global footprint. Over the past 5 years, the stock has shown about 7.65% growth, one-year return of 9.97%. Now, while this outperformed the broader industry, it did underperform the broader index's return, which was around 26.34% as of early February 2025.
Okay.
Its market capitalization reached a staggering $254.77 billion in 2023.
So zooming out for a moment, what does this tell us about Coca-Cola as an investment? While it might not be a high flyer promising, explosive short-term gains, its stability and steady growth make it a rock-solid choice for conservative investors, or those seeking a consistent income stream.
Right. People might cut back on luxury goods during tough economic times, but a Coke or another Coca-Cola product is often seen as a small, affordable treat. That ensures consistent demand.
And analyst ratings are optimistic. Average strong buy, price target suggesting a double-digit increase from its early 2025 price, indicating strong buy sentiment.
The broader implication here is that this offers you a balance, stability, and long-term value appreciation. It's about consistent, dependable growth rather than volatile, exciting gains. The fact that the average brokerage recommendation shows a trend towards stronger buy sentiment in recent months speaks to the confidence in its long-term trajectory. While its valuation, in the 20s for its earnings multiple is higher than it was maybe a decade ago, it reflects a premium placed on its stability, its dividend prowess, and that enduring brand power.
Right. In a world that is constantly changing, even a company as iconic and deeply rooted as Coca-Cola just can't afford to stand still.
Yeah.
Innovation is absolutely at its core, a survival mechanism, really. They continue to adapt to changing consumer tastes, which is evident in their successful zero-sugar options, growing range of health-focused beverages. And here's where it gets particularly intriguing. They're not just sticking to the classics. They're experimenting with things like Sprite plus tea,
Yeah.
which apparently started as an experimental project, scaled due to strong consumer demand, positive social media reaction. For such a huge established company, what does an experiment like that tell us about Coca-Cola's internal culture? It feels like they're fostering this agile, almost startup-like experimentation within a century-old behemoth. That's a profound shift, isn't it?
It absolutely is a profound shift, and that's the true insight here, I think. This continuous internal-driven innovation is crucial for long-term sustainability, staying relevant in an ever-evolving market. Coca-Cola Zero Sugar, for instance, achieved double-digit volume growth for 4 consecutive quarters, highlights the success of their adaptation to the health and wellness trend.
Wow.
And thanks to this kind of on-brand innovation, Sprite became the #3 sparkling soft drink in the U.S., according to Beverage Digest, in April 2025. This fall in the U.S., they also plan to launch that new Coca-Cola offering made with U.S. cane sugar. Reflects consumer interest in differentiated experiences, providing more choices, tapping into maybe nostalgia for unique tastes. It shows a company willing to iterate and respond to evolving preferences, even for its flagship product.
This demonstrates that even a company with, what, $30 billion brands?
Yeah, something like that.
Isn't resting on its laurels. They are actively seeking new ways to meet your evolving preferences, from traditional sodas to new exciting flavor profiles. It's a proactive approach, staying ahead of trends, ensuring they capture the next generation of consumers. And beyond innovation in existing categories, they're also strategically expanding their product portfolio into entirely new market segments. But what are the challenges of integrating such diverse new products and brands into this vast global system? Must be tricky.
What's fascinating here is how deliberate their expansion is, and how they seem to overcome those challenges through your Agile model. They're making strategic acquisitions, like Bilson's, that premium alcohol RTD brand in Australia, expanding into plant-based beverages like ADS, functional beverages with added vitamins, minerals, maintaining a strong focus on the overall ready-to-drink cold beverage market. Their move into alcohol RTD is a clear signal, I think, of their strategic intent to capture new growth opportunities, even if it brings new challenges in an increasingly competitive landscape. And the asset-light model helps here, right? They often leverage existing bottler relationships or create new specialized partnerships. This broad diversification mitigates risks from changing consumer trends in traditional segments, ensuring they can capture growth wherever it appears, by essentially creating, like you said, a drink for every occasion.
They truly are targeting every drink occasion you can imagine. Sparkling soft drinks, Coke Zero Sugar, Diet Coke, Sprite, Fanta, Waters, Dasani Smart Water, juices and dairy, Minute Maid Simply Fairlife, teas and coffees, Fuse Tea, Costa Coffee, energy drinks, Monster Energy, and, of course, those alcohol RTD options like Jack Daniels and Coca-Cola. They are ensuring they're always an option for you, whatever your needs or preferences. It's an incredibly comprehensive approach, seeking to embed themselves in every aspect of your daily consumption.
And this comprehensive approach is deeply intertwined with their sophisticated marketing transformation and consumer engagement strategies. The insight here, I think, is their unparalleled ability to leverage global scale while simultaneously adapting to local markets, quickly testing ideas, sharing learnings across regions, then scaling successful campaigns. Take the global relaunch of the iconic Share a Coke campaign. Put over 30,000 names on roughly 10 billion bottles and cans, 120-plus countries, tapping into universal nostalgia, even using connected packaging to enhance engagement. The This Is My Taste campaign for Diet Coke, inspired by social media insights, contributed significantly to volume growth in North America by speaking directly to how consumers describe their connection to the brand, using terms like crispy taste. They are master storytellers, finding new ways to make the brand personal.
It's like they're a master storyteller, constantly finding new ways to connect with us, whether it's universal nostalgia like personalized Coke bottles or something as specific as that crispy taste of Diet Coke. Campaigns like Juntos por Cien Años in Mexico, highlighting their economic contribution, or their World Cup activation, giving away 1,000 tickets, demonstrate their ability to craft tailored, impactful marketing that resonates deeply locally. How do they manage to maintain that authenticity across such diverse cultures, languages, avoiding a one-size-fits-all approach that might feel, tone deaf?
It's precisely because of that asset-light model, I believe, and the decentralized structure that empowers local bottlers and marketing teams. They tap into local insights, traditions, consumer behaviors to craft campaigns that feel indigenous rather than imposed from Atlanta.
Oh, okay.
It's a blend of global strategy and local execution. This isn't just advertising. It's about creating cultural moments, personal connections that make you feel a part of the brand itself. And underlying all of this is their sophisticated revenue growth management, or RGM, capabilities. Now, this isn't just a buzzword. It's a critical data-driven strategy focused on having the right products and the right packages at the right price points in the right channels with the right messages to precisely meet diverse consumer needs. They are transforming vast amounts of data into segmented insights to identify new opportunities. For instance, they piloted an AI-based packed price channel optimization tool in Mexico, now scaled to 8 markets across 4 operating units, demonstrates incredible speed to market, responsiveness to what the data tells them.
This raises an important question, though. Is RGM just about maximizing profit, or is it genuinely about understanding the diverse needs of consumers globally and ensuring they have access to an affordable option alongside premium choices? It sounds like an intricate dance between consumer value and corporate profitability. It's absolutely both. And that's the delicate balance. RGM allows them to optimize profitability, yes, but it fundamentally requires a deep understanding of consumer behavior, willingness to pay across different demographics, economic strata. The insight is that this intricate strategy has allowed them to consistently grow transactions ahead of volume and generate positive mix benefits. For example, by focusing on lower-cost single-serve offerings in Latin America and India, they added over 130 million transactions year-to-date in juice drinks.
Wow.
And they're growing refillables in Africa, the Philippines, Thailand, parts of Eurasia, Middle East, while leveraging their North American experience to grow mini cans in Europe. This means that whether you're looking for a budget-friendly option or a premium indulgence, Coca-Cola aims to have something perfectly tailored for you wherever you are in the world.
Okay. In today's interconnected world, a company of Coca-Cola's stature cannot, and frankly should not, ignore its environmental impact. This brings us to their ambitious World Without Waste campaign, a central commitment to reduce its environmental footprint through comprehensive initiatives. This includes aggressive water replenishment, ambitious packaging recycling targets, sustainable sourcing, significant carbon emissions reduction efforts across their entire value chain. Okay, let's unpack this. World Without Waste. It sounds incredibly ambitious, almost utopian. Are they really walking the talk, or is it more, aspirational marketing? This campaign clearly reflects a global trend towards corporate responsibility, but it's also, let's be honest, a direct response to increasing consumer and regulatory pressure.
It's definitely a multifaceted approach with significant actions, but also, ongoing challenges. In water stewardship, for example, Coca-Cola aims to replenish over 100% of the water used in its finished products globally. Focusing on efficiency in their plans, returning treated water to communities, they've consistently met these goals since 2015, have partnerships with organizations like the World Wildlife Fund, leading to tangible achievements like creating water reserves in Guatemala, protecting species like the Yangtze finless porpoise.
Okay.
In packaging recycling, the company aims for 35% to 40% recycled material in its primary packaging by 2035. Coca-Cola HBC, one of their big bottling partners, is working towards a 75% collection rate by 2025. They achieved 56% in 2023. They're also transitioning to 100% PET, that's recycled PET plastic in some markets, introducing innovations like the plant bottle, keel clip for multi-pack cans to eliminate plastic film, and light pack top for large multi-packs to reduce shrink wrap.
Those are significant initiatives across several fronts. And beyond water and packaging, they're also committed to emissions reduction, right? Coca-Cola HBC targeting net zero emissions across its entire value chain by 2040, investing in renewable energy efficient practices. They also work with suppliers for sustainable agricultural practices across their supply chain. It's clear they are investing heavily in these areas, but it's also important to acknowledge that this sustainability journey isn't, it's not linear, nor is it without its bumps and challenges.
And this raises an important question that consumers and environmental groups frequently pose. While their initiatives are significant, Coca-Cola has, in fact, scaled back some of its initial ambitious goals. They initially aimed for 50% recycled content by 2030 and 100% packaging collection by the same year, but these targets have been adjusted. This scaling back has drawn criticism from environmental groups, and it highlights the immense practical challenges of balancing grand sustainability ambitions with the operational realities for a company of this global scale. It's a complex balancing act, often fraught with difficulty, between aspirational goals and achievable targets within real-world logistical, infrastructural, economic constraints. For instance, they reported 90% recyclability rate for their packaging. Well, it faces scrutiny because simply being recyclable doesn't mean it gets recycled,
That's
right?
a big difference.
Huge difference. There are often immense challenges with collection infrastructure, contamination and waste streams, sufficient end market demand for recycled materials.
So for you, the environmentally conscious consumer, Coca-Cola's journey shows that even major corporations are grappling with these incredibly complex issues, and that progress isn't always linear or without its critics. What do you think is the biggest trade-off they face here? Is it the cost of implementing these solutions, or the sheer logistical nightmare of changing packaging and recycling infrastructure globally? Seems like an intricate puzzle where every piece has a cost.
It's definitely a combination, but I'd lean towards the sheer logistical complexity and the lack of consistent recycling infrastructure globally being immense hurdles. The cost is significant, yes, but investing in infrastructure and educating consumers worldwide about recycling can often be outside a single company's direct control. So they're navigating that external reality. It invites critical thinking about corporate sustainability efforts. It's not just about what a company says it will do, but the practical effectiveness and scope of its actions, and the honest acknowledgement of challenges. It's a dynamic, ongoing process that everyone, including their shareholders and consumers, is watching very closely. Okay, so as we look to the road ahead, it's essential to consider the key risk factors that actively shape Coca-Cola's strategic decisions, ensuring its long-term viability. Firstly, changing consumer preferences remain a constant challenge. Growing global shift towards health-conscious alternatives to sugary drinks. Not new, but accelerating. Secondly, increased competition is ever present. Not just from long-standing rivals like PepsiCo, they hold about 30% of the market compared to Coke's 40%, but also from a myriad of agile, emerging brands that can quickly capture niche markets. Thirdly, regulatory challenges are intensifying globally. Sugar taxes, single-use plastics bans, complex labeling requirements, it's a minefield. Fourthly, currency risks are significant. A substantial portion of their revenue comes from outside the U.S., impacting reported earnings when those foreign currencies are converted back to dollars.
Always a factor for global companies.
Always. And finally, even a small product recall, like a recent one in Europe due to slightly elevated chlorate levels in a specific batch, it can cause reputational damage even if the risk to consumers is very low.
If we connect this to the bigger picture, that these risks aren't just hypothetical, right? They are actively shaping Coca-Cola's strategic decisions, from aggressive product innovation to substantial sustainability investments. Their innovation agenda, Coke Zero Sugar, plant-based options, expansion into functional beverages, alcohol or RTD. It's a direct and calculated response to these evolving health trends and competitive pressures. And your choices as a consumer play a significant role in these dynamics, signaling demand for certain products or packaging. These are the external pressures that constantly demand adaptation from a global leader, highlights of the nonstop challenge of staying on top.
Turning to their recent performance, Coca-Cola reported its second quarter 2025 results, and it presented, well, a mixed picture, yet with a strong underlying narrative of resilience. Global unit case volumes saw a slight decline of 1%. Management attributed it to a tough prior year comparison, adverse weather in some key markets, pockets of consumer pressure, especially in June. However, the more crucial insight, I think, lies in their financial leverage. Net revenues grew 1%, but more impressively, their organic revenues, that's a non-GAAP measure, excluding currency and structural changes, gives a clearer picture of the core business grew a robust 5%.
Okay, 5% organic growth is solid.
Very solid. Driven by a strong 6% price mix, showing their pricing power even with a 1% decline in concentrate sales. This ability to command higher prices to offset volume dips is a hallmark of strong brand equity. Operating income saw impressive growth, and comparable EPS grew 4%, notably despite a significant 5-point currency headwind and a higher tax rate. Showcases strong cost management.
So what does this all mean for us? They're seeing a mixed bag globally, but Chairman and CEO James Quincey emphasized their all-weather strategy and ability to pivot plans amidst a choppy external environment with rapid turns of events. This adaptability is clearly their strategic compass. While operating cash flow was negative, $1.4 billion in Q2, that largely reflects a substantial one-off $6.1 billion payment for the Fairlife acquisition's contingent consideration. Big, but expected payout for a very successful brand.
Exactly, a one-off.
Excluding this payment, free cash flow was a healthy $3.9 billion, up $600 million year over year. They also gained value share in total non-alcoholic ready-to-drink beverages for the 17th consecutive quarter, which speaks volumes to their underlying brand strength and effective execution in a challenging market.
Absolutely. Regionally, the picture was nuanced. North America. Volume declined slightly, but improved sequentially. Strong share gains. Resolution of some specific consumer issues. Latin America, volume also declined, but they achieved a remarkable 15% price mix growth. Shows very strong pricing power there, despite weather challenges.
15%, wow.
Yeah. EMEA, Europe, Middle East and Africa saw solid volume and profit growth across all units, even amid conflicts and a worsening macro outlook in parts of Africa. Asia-Pacific, however, was more mixed, impacted by factors like early monsoons, geopolitical issues in India, while China actually saw volume growth despite cautious consumer sentiment. This granular yet responsive approach underscores their global agility.
All that regional detail paints a picture of a company facing specific headwinds in certain areas, but demonstrating remarkable agility and pricing power to navigate them. Which brings us to Fairlife. Continues to be a shining star for them. Fairlife continued its strong double-digit volume growth in Q2, but as you mentioned earlier, it moderated slightly due to capacity constraints. This is a good problem to have in a sense, but it highlights the need for investment. What are the implications of such strong, yet capacity-limited growth for their future strategy?
This raises an important question regarding Fairlife, yeah? The new facility in New York, slated to come online early 2026, will ramp up throughout the year. Crucially, it will debottleneck capacity for all Fairlife variants. They also have options to expand existing facilities. This investment clearly shows a long-term play on consumer protein and value-added dairy trends, which are incredibly strong right now, show no signs of abating.
Right, protein is huge.
Huge. Fairlife and Core Power are strongly differentiated, and the focus is on providing those clear consumer benefits. They are also looking for international opportunities, acknowledging that the dairy industry structure differs significantly from the U.S., but the underlying protein trend is global. For instance, Santa Clara in Mexico, their value-added dairy business there, is already #1 in its segment. It's a strategic bet on a growing health-conscious category.
That's a huge positive. Points to a clear growth engine. But even a giant like Coke doesn't hit a home run every single time, and it's interesting to hear their honesty about it. Their coffee strategy, particularly with Costa, hasn't played out exactly as expected. They openly state that their investment in Costa is not where we wanted it to be from an investment hypothesis perspective. The business remains weighted towards stores, which are performing well, focus on affordability, refresh stores, speed of service, but the planned acceleration in RTD coffee and express machines hasn't materialized as they hoped. What are they learning from this? And what does it reveal about the challenges of expanding into new segments, even with a strong brand and capital?
It definitely shows the challenges of expanding into fragmented, highly competitive categories, even with significant investment and a strong brand like Costa. The insight here, I think, is that coffee, especially in the ready-to-drink segment, is just hyper-competitive. Many established players.
Yeah, very crowded market.
Very. They're learning that simply having a brand isn't enough. Execution, speed to market, unique differentiation in highly saturated areas are crucial. It's a learning experience for them. And they are in the mode of reflecting on those learnings, exploring new avenues for growth in coffee, ensuring the Costa business continues to run successfully in its core store format. It's actually a testament to their transparency, I think, willingness to acknowledge areas that need reevaluation rather than just glossing over them.
Looking ahead, Coca-Cola's updated full-year 2025 guidance reflects a continued focus on growth. Despite the dynamic environment, they still expect organic revenue growth of 5% to 6%, which is strong.
Still strong, yeah.
Comparable currency-neutral EPS growth is now expected to be approximately 8%, aligning with their long-term algorithm. While comparable EPS growth is anticipated at about 3% versus $2.88 in 2024, this primarily reflects a significant 5% currency headwind and a 1% headwind from acquisitions divestitures, so external factors rather than core business weakness.
Right, mostly FX impact.
Free cash flow, excluding that Fairlife payment, projected around $9.5 billion. Underlying effective tax rate estimated at 20.8%.
What's fascinating here is that despite the choppy environment and significant currency headwinds, management is confident in hitting its long-term growth algorithm for organic revenue and EPS. This speaks to the underlying strength of their brands, their execution capabilities, even amidst global volatility. Analyst sentiment is also quite strong. Average strong buy rating for KO stock, average price target, suggesting a healthy increase from its current price. This optimism has actually trended towards a stronger buy sentiment in recent months, signals continued confidence in its stability and long-term prospects.
So for you, this updated guidance and analyst optimism provide a forward-looking perspective. Suggests continued resilience and a positive, albeit moderated by external factors, outlook for the year. It's about consistent, dependable performance from a company built for the long haul, one that continues to deliver value even in an unpredictable world. Wow, what a journey. We've truly journeyed through Coca-Cola's remarkable 135-year history, dissected its incredibly agile asset-light business model, celebrated its dividend king status and the profound financial fortitude behind it, seen its relentless commitment to innovation and sustainability, and understood how it skillfully navigates a truly dynamic and often challenging global market. It's a company that is somehow both an old, beloved classic and a relentless strategic innovator.
Yeah, what stands out most to me is Coca-Cola's unparalleled ability to blend tradition with transformation. They are a dividend stalwart, deeply rooted in consumer loyalty, global brand recognition. Yet they are constantly pushing the boundaries. New products, evolving marketing strategies, operational efficiencies like their AI-powered RGM tools. They are truly an all-weather business, consistently pivoting, adapting to whatever the global landscape shifting consumer tastes, geopolitical conflicts, currency fluctuations throws their way. Their long-term vision, coupled with that short-term agility, is a powerful combination that, frankly, few companies can replicate.
So as Coca-Cola continues its quest to refresh the world, the question for you is, can this iconic brand, which has successfully pivoted through over a century of profound change and consistently adapted its core business, can it continue to innovate fast enough to capture the next generation of consumers? Consumers who demand ever faster shifts, increasingly personalized experiences, or will its sheer size and established legacy eventually become a limitation in a world demanding constant, radical reinvention? What do you think?